Okay, in this section of class, what we're going to do is we're going to talk about stocks. All right. So I think I said this in class before. If any of you ever want to retire, you're going to have to buy stock. All right. Whether you do that individually, whether you buy individual stocks for your portfolio, or whether you invest in mutual funds or index funds where the mutual fund manager will buy the stocks for you. But if you want to retire, you're going to have to own some stocks either directly or indirectly through a fund. Okay, so it's important to understand how financial analysts might think about pricing these stocks. Recall in the previous section of class when we talked about pricing bonds, we said that the price of any asset is equal to the sum of the present value of its future cash flows. So for instance, the price of a bond is equal to the sum of the present value of each of the coupons that bond will pay. So I'm discounting the coupons back by some rate R, or the yield to maturity, and I'm summing up those present values, and I'm adding the present value of the face value or par value of the bond that's discounted back by the yield to maturity that happens at maturity. Does this make sense? So this is the price of the bond is equal to the sum of the present value of the future cash flows. So when we talk about stocks, we're going to use the same intuition. We're going to price these stocks as the sum of the present value of the future cash flows that the stock will pay out to shareholders. And what are the cash flows that the stock pays out to shareholders? Of course, those are dividends, okay? So what we're going to do is we're going to use this bond pricing formula, and instead of looking at coupons that are specified by the firm, we're going to look at dividends specified by the firm. And instead of discounting back by the yield to maturity, or the real interest rate that bondholders charge the firm, we're going to use the required rate of return by shareholders. Okay, so we're going to discount these coupons, but not coupons. We're going to discount these dividends back by some rate R, and then we're going to discount back the face value of the stock or the price of the stock at some time in the future back by this rate. So we have to understand something about dividends. A couple of things. First, a firm has net income at the end of the quarter. They will choose to pay a portion of that net income out as dividends. And the total amount of dividends is the amount of dollars that a firm pays out of their net income. Okay? The dividend per share is the total dividends divided by shares outstanding. And the dividend yield is equal to the amount of dividend per share divided by the price per share. So make sure you understand the difference between when I say dividends, I mean maybe the total amount of dividends. When I say dividend per share, we're talking about the price of the dividend, the total amount of dividends divided by the shares outstanding, or the dividend per share. And when I talk about the dividend yield, I'm talking about the dividends per share divided by the price per share. Okay. Let's briefly look at something here. So here's Apple. So this is Apple. Oh, down 13% again today. It's been a horrible day for markets. One of the craziest days, in fact, the craziest day in the last 33 years, okay, since 1987. Apple's down 13%. Notice that Apple here pays a dividend per share of 77 cents. So for every share that you might own of Apple, you'll receive a dividend of 77 cents per share every quarter. It just automatically gets fed into your brokerage account, I'll leave it at that. It amounts to $3.08 million of dividends that are paid out every quarter, and notice that the dividend yield is 1.27%. Okay, so let's compare that to Microsoft. Okay, Microsoft has a higher dividend yield of 1.51%, but they pay less dividends, 2.04 million, and a dividend per share of 51 cents. Does this make sense? So the dividend yield is telling us how much of a dividend are we getting relative to the share price. The dividend per share is telling us how much in dollar terms we get from the firm. And these are important things to understand before we begin pricing these dividends using the dividend discount model.